What's up guys, John here. Just a few days ago, Jerome Powell announced that the Federal Reserve has cut interest rates by 25 basis points, the first time doing so in roughly 9 months.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point.
From Wall Street to Main Street, signs this morning of economic relief, with the Federal Reserve lowering interest rates by a 1/4 point. The first cut so far this year, now bringing benchmark rates down to 4 to 4.25%.
Now on the surface, this might sound like great news, right? Cheaper borrowing, perhaps lower interest rates on credit card APRs, maybe even a little bit of relief for homebuyers. But here's the problem. The Fed didn't cut interest rates because the economy is strong. They cut interest rates because Jerome Powell and his team are worried that the job market is cracking, all while inflation is running hot. And Powell didn't sugarcoat it. He said there's no risk-free path forward.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you gotta be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path.
In other words, no matter what the Fed does, someone's going to get hurt. If they cut too hard, inflation's going to roar back even harder. If they don't cut enough, the job market could unravel. And right now, everyday Americans are caught in the middle of a tug of war. So what exactly is Powell warning about? The word he keeps dancing around is stagflation. And if you've never lived through it, here's a little breakdown. It's the worst of both worlds. Prices keep climbing and the job market stalls and job opportunities are fewer and farther between. Think about it. Inflation on its own is painful for most.
You've stressed over your grocery bill lately, and you are not alone. A new poll revealing that most Americans are worried about paying for food at the store.
Americans are feeling the pinch at the grocery store.
It's depressing.
But at least people are still working. A recession on its own is tough, but usually prices fall and things get cheaper. Stagflation is when you're paying more for groceries, rent, and gas. And it's getting harder to get a paycheck to cover those costs. That is ultimately a nightmare scenario.
Consumer sentiment dropped nearly 5% compared to last month. And on top of that, the latest inflation figures show consumer prices rose 0.4% last month, bringing the annual rate to 2.9%. Plus, for the first time in 4 years, there are more people looking for work than there are jobs available for them.
The Fed's own projections are that we're now stuck in this longer than they imagined. They now expect inflation to be elevated until at least 2028. That means their famous 2% target, we might not see that for a couple years, if ever. Remember when Janet Yellen famously said, inflation, that's transitory? Well, that was 4 years ago. That was a lot more permanent than what Americans are promised. And here's where reality hits home. Because stagflation doesn't just live in some Federal Reserve chart. It crushes the middle class. Right now, the top 10% of earners account for 50% of all American spending. They own 87% of all stocks and almost half of all American housing. Meanwhile, the bottom 90% own just 13% of American stocks. And they carry most of the consumer debt. So when inflation lingers for years, who do you think feels it most? It's the families paying higher insurance premiums on their home, watching grocery prices go up by 20%, or struggling to come up with the extra revenue to pay the government through increased property taxes. It's the renters who find out now that it's actually cheaper to rent than it is to own in most American cities. It's not because rent is very cheap. It's that the cost to own a home is outrageous.
There's new data just released this morning by Bankrate, and it shows that in cities nationwide, it is now cheaper to rent than actually own a home.
And here's the kicker. If you lose your jobs, banks don't care about almost steady income. To get a mortgage, you generally need 2 years of stable checks. One pink slip and that mortgage ladder slowly gets pulled away. So while American families are now being forced to give up vacations, cut back on groceries, and walk away from properties they can no longer afford, the wealthy are sitting on record high stock gains and record high real estate appreciation. The gap, it's only going to get wider in the years to come. Now here's the part that stings even more. While the middle class is getting squeezed, the top 10% are thriving. Think about it. When everyday American families can't keep up with their mortgage, who's waiting on the sidelines with cash ready? Wealthy investors, entrepreneurs, business owners. And they'll scoop up homes, land, and businesses at steep discounts. It's the same with stocks. Most of Americans don't own enough shares for it to matter. But the top 10% own roughly half of all available stocks. So when the market dips, they'll just buy more. This is why Powell's warning isn't just about inflation. It's about a massive wealth transfer. The wealth transfer I've been warning about on this channel for the last couple of years. The bottom 90% are going to be forced to sell, while the top 10% are expanding their portfolios and getting out of depreciating fiat currency and into hard real assets. It's not about money at this point. It's about power. It's about control. And it's about opportunity. You're already seeing it on Wall Street. Investors are calling it the biggest buying opportunity in more than a decade. Twitter's full of stock portfolios bragging about record high gains, while working class families are maxing out credit cards to simply buy groceries.
25% of Americans who have buy now, pay later loans are using them to help afford groceries. 41% of those customers admit to making a late payment on a loan.
And if inflation drags on for many more years, who do you think comes out on top? It's not the guy at the grocery checkout putting it on buy now, pay later. So here's the dilemma faced by Jerome Powell and the Federal Reserve. Do they fight inflation or do they protect jobs? Because they can't really do both at the same time. This recent rate cut, just 0.25%, was what Powell called a risk management move.
I think you could think of this in a way as a risk management cut because a very different picture of the risks to the labor market.
Translation, the Fed sees cracks in the labor market. Layoffs are creeping up.
Meanwhile, new figures show layoffs reached the highest levels last month since the height of the COVID pandemic.
And inflation continues to move above 2%. It's like they're trying to put out a fire in one room of the house as the flames move on to the next room. They cut rates too much and inflation is going to roar back, making everything from rent to groceries even more unaffordable. Keep rates for too high for too long, the job market will get punished. People lose incomes and businesses will cut back. And the recession risk, it continues to shoot up higher and higher, although many already believe we're already in a deep recession. And here's where all this could lead if things keep moving in this direction. We're already seeing warning signs in the credit markets. Credit card delinquencies are climbing.
As the number of accounts with delinquent balances has more than doubled since 2021. A record high number of people are only paying the minimum monthly payment on their credit card bills.
Auto loan defaults are ticking up, and mortgage defaults are starting to bubble below the surface. For many homeowners, the pressure is relentless. Insurance premiums are skyrocketing because the cost of repairing and replacing properties continues to grow. Property taxes are climbing in almost every city in the country, and if your paycheck takes a hit, whether it's from layoffs or fewer hours at work, it doesn't take long before the math no longer works. That's when families start walking away from homes they fought so hard to buy. But here's the danger many investors are overlooking. If you're borrowing heavily because money looks cheap after a small rate cut, you're underwriting your deals based on today's cash flow. But fast forward just a couple years, insurance premiums will likely go up in a substantial way. And with it, property taxes, repair costs, vacancies, everything is gonna cost more. So what could look like a great opportunity today could be a nightmare tomorrow. That's why Powell said there's no risk-free path, because whichever way the Fed leans, these cracks in the system will only get deeper. And for everyday Americans, these cracks aren't abstract. They'll show up in bills, in debt, and in lost homes. So what does this all mean for you, sitting at home watching this? If you're a worker, it likely means that your paycheck isn't stretching as far as it needs to. And there's no guarantee that the job opportunity will be there if the businesses continue to see their costs rise and they need to cut expenses. And raises simply aren't keeping up with inflation in most cases. So even if you are getting a raise, it's likely not keeping up with inflation. And if you're renting, it likely means higher rents with fewer options. Because landlords, like all businesses, when they see their cost increase, they push it on to the consumer. And with so many Americans locked out of homeownership, the competition for rentals will continue to push the prices up. If you're a homeowner, it means budgeting for more than just your mortgage. Insurance, property taxes, maintenance, it's gonna continue to rise. And if you're one of the millions out there thinking about refinancing, you need to ask yourself a very simple question. Am I building enough margin to offset the rising costs that will be coming down the road? And if you're an investor, this is both a warning sign and a major opportunity. Yes, borrowing against the depreciating dollar can help you build wealth, but only if you don't over leverage and you can pivot and move during the hard times. Because the same inflation that makes assets more valuable also makes everything extremely expensive to maintain. At the end of the day, the people that are gonna come out on top are gonna be the ones that plan ahead. They plan cautiously and they have large stocks of cash to pivot and move as things get more expensive. They're not gonna go all in and bet the farm on today's news. They're going to plan for uncertainty. The ones that get hurt are the ones living paycheck to paycheck, or the ones that are betting everything that tomorrow will look very similar to today. So all this sounds heavy. It's not just doom and gloom. There are smart ways to play defense. And I've seen this coming, and here's how I'm approaching it personally. I just relocated but about 10 months ago, I relocated my family from Florida to Cleveland, and we've been buying single family homes in very nice communities, myself and for investors. And we've been buying, essentially closing on a house nearly every other day. And we have a crew of about 70 people. The crew is expanding rapidly. We just hired a full-time team member who used to work directly at the housing authority that does our pre-inspections at Section 8. And we're looking to really pick up a lot of momentum as this affordability crisis gets worse. Because what are people going to do, right? People are going to be moving towards affordability. And if it costs $300,000-$400,000 to build a house, and we're buying them for $80,000, $90,000, $100,000, and we're renovating them to today's standards, what's going to happen is people aren't going to be able to build in the communities in which we're buying, and there's going to be more demand for these rentals. Prices are going to be going up on the rental side. It's going to be a really good place to park capital. It's my opinion. If you'd like to learn more, you can click the link in the description. If you have between $500,000 and $1 million liquid, you can click the link below. So when Jerome Powell says there's no risk-free path, this is exactly what he means. The middle class is carrying the burden, and the smart are positioning themselves to get even richer. And the Fed is stuck deciding which part of the economy is going to get hit. The truth is, we're heading in to a living standard crisis in this country that will be felt by the bottom 90%. The real question, and the only question, is, do you think the Fed can actually get this under control? Or are we staring at the lost decade for the middle class? Let me know your thoughts below, and I'll catch you next video.